There's one line on a tax form that investors fill out wrong more than almost any other, and the IRS is absolutely counting on you not to notice. We're talking about a mistake that can cost you hundreds, sometimes thousands of dollars, and the wildest part is that it's hiding in plain sight. The culprit is Schedule D, specifically the part where you report your cost basis. And it sounds boring until you realize the government has quietly made it more complicated over the last decade or so. Ever since brokers were required to report cost basis starting around 2011, the rules changed in ways most investors never got the memo on. Here's what actually happens. You sell a stock or a fund, you get a Form 1099-B in the mail, and you assume the number in the cost basis box is correct, so you just copy it over like a good little taxpayer. But that number can be wrong, adjusted, missing, or calculated using a method that's not actually in your best financial interest. Think of cost basis like the receipt for something you bought at a store, except imagine the store had 4 different ways to calculate what you paid depending on which cashier you asked. FIFO, LIFO, specific identification, average cost, these aren't just accounting jargon. They're levers that can dramatically shift how much taxable gain you're reporting. Most brokers default to FIFO, which means first in, first out. So the shares you bought earliest get sold first. And if those older shares have massive gains, congratulations. You just volunteered for a bigger tax bill. The irony is that with one conversation with your broker before you sell, you could have designated specific higher cost shares and legally kept more money in your pocket. Here's where behavioral economics walks in wearing a trench coat. Investors almost never think about this before selling because selling feels emotional, urgent, reactive. You're watching the ticker, you're making the move, and nobody's pausing to think about lot selection. It's the financial equivalent of grabbing whatever's closest in the fridge instead of actually cooking something good for you. Now, historically, this wasn't as big a deal when brokers didn't report basis at all and you tracked everything yourself. People either got it right, got it wrong, or just guessed and prayed. But now that brokers report to the IRS directly, any mismatch between what you report and what they reported is a flashing red flag in an automated system that never sleeps and never forgets. The misconception we need to kill right now is that the IRS will just figure it out, or that a small error won't matter. An unreported or mismatched cost basis can trigger a CP 2000 notice, which assumes your entire proceeds are pure gain, meaning you could owe taxes on money you already paid taxes on, which is exactly as infuriating as it sounds. Here's the practical play. Before you sell anything, call or log into your brokerage and confirm both what cost basis method is on file and whether the basis is even marked as covered versus non-covered. Non-covered shares, typically those bought before the reporting rules kicked in, may have no basis on file at all, and you are responsible for proving what you paid. The historical lesson that actually sticks is this. The investors who avoided this mess weren't necessarily smarter. They were just more organized. They kept trade confirmations, old statements, reinvestment records, and they treated their portfolio like a business with receipts, not a lucky scratch ticket. Discipline around documentation is genuinely unsexy, and it is genuinely the difference between a clean return and an audit headache. And look, we can acknowledge the absurdity here. The tax code is so layered that a decision as mundane as which shares you sell first can change your outcome by thousands of dollars, and almost nobody talks about it at dinner. Meanwhile, people spend hours researching which stock to buy and approximately 0 minutes thinking about the tax efficiency of how they exit. The broader cycle is predictable. Complexity gets added to the tax code, most people don't notice. A small group optimizes around it, and eventually someone makes a YouTube video about it a decade too late. What we want for you is to be in that small group now, not the cautionary tale later. So the move is simple. Slow down before you sell, check your lots, confirm your basis, consider the holding period. Short-term gains are taxed as ordinary income. Long-term gains get the better rate, and make the decision that costs you the least, not just the one that feels the most satisfying in the moment. Process over impulse every single time. At the end of the day, the investors who consistently win aren't the ones with the hottest picks. They're the ones who lose the least to taxes, fees, and sloppy paperwork. And that edge compounds quietly and powerfully over time. Discipline, documentation, and a little attention to the boring stuff is genuinely one of the highest return activities you can do as an investor. And if you're ready to take the next step, whether that's real estate investing, finding contractors for your next project, or connecting with the right lenders, check out our links in the description below and let us help you get started.